Non-Farm Payroll Friday. Welcome to the first day of the rest of the summer. No Fed in August, so a reasonably important report to set the tone. We'll get ready to do a live reaction on that. In the meantime, while folks join, I'll sort of stall a little bit and talk about let's talk about yesterday afternoon's action. Pretty sure today Fanny's roll, right? No, is that Monday? No, Fanny's are already rolled. Right? Was that yesterday, actually? No, what am I talking about? Today's only the 7th. No, next week, Fanny's roll. My bad. Seth is the one that's the overlord of the screen nowadays. So bonds a little bit better today. Sort of sold off a little bit into the afternoon. So, round numbers were kind of back at yesterday morning's levels. In the overnight, Asia mostly down, Europe mostly up, stock futures up, VIX at 15 and change, slightly up, Bitcoin 65,000. Commodities, you've got crude oil at 76 and change. Most metals are up. Both oils are down. No real news out of Iran other than sort of the continued back and forth. Let's see, up to the minute. By the way, if you have a guess on non-farm, post it. Yeah, 7 hours ago, Tehran. I almost believe Tehran more than our White House, not because I believe that that the White House is lying, but I think that Iran is so volatile that answer changes from minute to minute and day to day. So, if we say we're close to a deal, I believe that we believe that. I just don't believe that they know what Iran is thinking. So when I hear Iran talking about a deal, I kind of like it. We're closer. That being said, I don't know how close we really are. Bonds and oil don't hate it, however. Overnight, mostly bond-friendly data. There was one inflation data point that was a little hot. Otherwise, most inflation data was actually benign. We've got 1 minute here to post, as they might say. We covered a little bit this morning, but that was just sort of overnight stuff. I got to tell you, we covered up yesterday morning, and that served us well as we sold off into the afternoon. One of the things I had talked about, bonds starting to rally really well here. Interesting. We are making maybe a call on this non-farm. Here we go. Negative 23,000. Wow. Revised down to 20. Unemployment rate. So funny. I would love to roll back the clock to yesterday. Didn't I say that we might get a bad number, but the unemployment rate go down? Holy cow. Here's the big one. Wages, 0.1. So we talked about this a little bit. That's pretty unique. What's amazing is, tens almost stuttered here. They're not rallying as much. Seth, tell me where MBS is. I don't know if we've broken the screen, but I don't see any action. Tens at 463. Guys, listen. Okay, I'm going to take a little bit of a victory lap here. What did I say about July data? What did I say about August interest rates? Set the calendar. I'm going to say set the effing calendar every effing year for the last 20-something years with almost no exceptions. August, September, rate friendly. And if you've been listening, we've been calling for that. What the hell is the Fed going to do? Now, I've got a hard stop at 9 and I'm going to FAMP, but we may go a little bit long here. Be ready for that, Seth. What I'm going to say is status quo. Shoot me in Rome or even here where live levels are. I want to know fives, 5.5s, and sixes, please. Participation rate down. Okay, so that's why the unemployment rate would go down. Let me see if I can get. Boy, I tell you something, mortgage folks, you may have just been bailed out. Not saying you need the bailout. We've been looking at where MBA apps are. Hold on, BLS, non-farm. But let's be honest, right? MBA apps have been lagging. Okay, August 7th. Both non-farm payroll, minus 23,000, unemployment rate changed little. By the way, minus 23,000 is not changed little, okay? Yeah, maybe it's only 70-odd thousand different month over month, and that, considering that we have a margin of error of 100,000 jobs, for the record, this number might not have changed. For all we know, and although we know that it won't get revised up, it hasn't in about, for all intents and purposes, 2 years. It's just negative revisions. But that being said, for all we know, we actually printed 70,000 jobs and we were up month over month. But psychologically, 50,000 jobs created, 23,000 jobs lost. Big. Okay? Changed little. Employment declined in local government, education, retail, trade. Employment continued to trend up in healthcare. 2 surveys, which does it say this every month? I don't know why we need to know this. Household and establishment. Number of unemployed people changed a little at 6.9. Among the major worker groups, teenagers 12.1, Hispanics 4.6, declined in July. Adult men, women, and people who are white, black, or Asian showed little change. More on that in a minute. I'm going to get, and we'll put it on the screen too. We'll get into the actual table. Layoffs, temp layoffs increased by 153,000 in 9/21. That challenger number is interesting. Permanent job losers, little changed. 5 weeks of unemployment edged down and is down by more than 344,000 year over year. They're saying the part rate, and I guess it did, and employment pop ratio changed little. Part-time for economic reasons changed little. People not in the labor force changed little. Those who wanted a job marginally attached little. The establishment survey local government declined by 50,000. That takes a little bit of the edge off because I've discounted prior numbers because there was a lot. 10-year moving now, Bob. Yeah, we're up 10 to 14 across the board. So MBS really catching a little bit of a bid here. Very interesting. Retail lost 19,000 jobs. Average work week was unchanged. Overtime edged down. Wow. May revised down 66 from 129 to 63. June revised down 37. My math is correct. It's 103 total revisions. 37 from 57 to 20. So let's step back for a second, put that into context. June 20, if July holds, and obviously there are going to be revisions, at negative 27 or worse, 2-month net job decline. Yeah, May, June, yeah, 103 combined lower plus like a 70 miss. So the 3-month outlook for the employment situation, right, is almost 200,000 jobs worse. Okay. Um, Let me see if I could get into. So let's do a screen share here. All right, let me know if you could see this, and it looks like you can, right? So we won't get too stuck in the weeds here. As I said, given my hard stop, but the employment to population ratio going down is bond friendly, obviously. But that explains the unemployment rate going down is not a silver lining to this report. Let's just be clear about that. A big drop in unemployment. Wow, this is interesting. So a big drop in unemployment amongst teenagers is incredibly bond friendly in that it makes this number actually worse than it really is. Flat among whites, down among African Americans. Again, statistically, of these segments, white, black, Asian, Hispanic, the lowest paying. And that's what you're looking for when you're looking in the internals: hours, wages, the types of jobs we may have gained or lost, part-time, high-paying, low-paying. So, and then the unemployment rate ticked up for Asians, which are the highest paid. So let's create some context around the race and gender and age-ish, because of the teenager table here. While the unemployment rate went down, mostly because of participation and population rate, it went down amongst the lowest wage cohorts and went up in the highest wage cohort. So that really makes this number worse than even the headline. Okay, here's more of a breakout of cohort. So unemployment rate went down against folks that didn't even graduate high school and no college. So just across the board, the job gainers, if you will, lower wage, the job losers, either flat or amongst the Asian cohort, went up. Job losers. Job losers overall went up. Re-entrants went up. Leavers went up. Re-entrants went down. New entrants went down. What I would say is, silver lining, not for bonds, but for the economy, duration of unemployment may be somewhat dovish. Less people over 27 weeks, could be the expiration of benefits at some point. So that's hard to say. And these two cohorts going up is actually bond friendly. But when you look at sort of, one would argue that the tails outweigh the belly if all things were equal. Part-time going up, again, makes this report look even worse. Not only did we lose jobs, hey Steve, but this would suggest we lost a greater proportion of full-time jobs. So everything and marginally attached went up. So this, as far as I'm concerned, right, in terms of the household survey, across the board, it's bad on top of bad on top of bad on top of bad, with almost no good. Okay, now let's look at the establishment survey. So this is so-called non-farm, right? This is the headline number. Minus 23, privates went up 30. So that internal is slightly bond unfriendly. If you want rates lower, you'd almost want privates to lose more so than government. Goods producing up. Uh, Get me to services. Services flat is good for bonds. Retail being down, very interesting. Suggestive of a slow beginning of the summer, right? People aren't buying bathing suits and suntan lotion, maybe. Um, Transportation, financial activities being negative, again, bond friendly. Leisure and hospitality, and we saw this, I forget what report. This is two reports, I think it was ADP. Again, is that forecasting a bad summer? Think about, and you know that I'm not a big sentiment guy. I think underlying, massively important. I think the way we digest it is maybe what's broken. I'm pretty sure we have sentiment at 10. But I want you to think about this. And I've said this in terms of that Santa Claus rally and the calendar in terms of interest rates. We get excited about Christmas come September, October. By December, January, we have the realization of, oh boy, this was another okay or bad holiday season, almost for the last 20 years, right? And so what I've said is this. When I think I've said it here, right? When we have a good August or a good September or a good October of sales or data, when the F else are you going to spend money? If you haven't spent money all year because you can't afford it, right? Of course you're going to spend it around the holidays. I don't get excited about gaudy holiday prints. Late Q3, early Q4 data, that doesn't excite me. When we talk about the Fed saying that inflation is transitory, I got news for you, okay? Any pop in sales, okay, around the holidays, in my opinion, is transitory. So leisure and hospitality being down, are we saying, right, from a sentiment standpoint, I don't feel great. I'm not going on vacation. I'm not going out to eat. I'm not buying a bathing suit, so on and so forth. To me, I look at the drop in leisure. I look at the drop in retail, and I really say, dig in. What is this telling us? That to me is maybe the most important part of this report for me. Hours unchanged, hourly earnings largely unchanged, weekly earnings, which to me is the bigger number, largely unchanged. Yeah, I mean, guys, there's just nothing to not like about this number. MBS loves it. We're back to approaching a par handle on 5.5s. You look at a 1 month chart, we're maybe mid-board on 5. So before we get away from ourselves, after yesterday's sell-off and so forth, let's remember where we came from, okay? July 6th, we were at par 16 on 5.5s. We're still a half a point back, okay? I do a 3 month. On June 26th, we're 75 basis points worse, okay? 6s, for me, are full-on lock today. We're back over a 102 handle. 6.5s, which we're long. Seth, we're going to have to look at that. Are catching a really nice bid here. We may want to look at that. And then down in coupon, for those of you that care about Ginny 4s, we're up a half a point. But I mean, we're still 3 points worse than April 14th. So what do you do today? It depends on when your loan's closing. Like this is, you are breathing. This is to me more of a sigh of relief, right? Than it is a lookout below moment. I'm not going to bullshit you guys though, and this is what I've tried to do on social media the last 5, 6, 7, 8 years, whatever it's been, 10 years. Originally LinkedIn with, but on Instagram and LinkedIn with my Market Minute. And why don't you do it more? And it's like, well, because when I say something, I want to say it. That's where, for me, this becomes a little bit difficult. Yeah, sixes are really trading. I mean, we are in that par and 102 handle on five and a halves and sixes. You know, I want, when I say something, I want to say it. That's why this format can be a little bit difficult. I don't have something important to say every day. It's just, hey, more of the same. What I would say to you is today's report means more potentially a month from now than it means today. What it means today, tomorrow, next week is a potential retracement of the fact that I've been saying the pendulum has swung way too far the other way. Rates should have never gotten as bad as they got. This fixes that, right? This doesn't put us in line with the reality of our economy, that I'm going to keep beating that drum. Main Street is not seeing what traders want to see in oil prices, what they think the Fed is going to see in inflation. If a tree falls in the woods and nobody hears it, who cares what CPI is if I'm not spending any money that I don't have? And that's where we get stuck in the weeds. Let me see if I can get a real-time Fed funds. So we had is this up to the minute, 55% probability of a Fed hike in September? This, barring a crazy August number, I'm telling you, 0% chance the Fed hikes unless something crazy happens in Iran, okay? If we have this report and a truce, there is no hike, full stop. And if there is, they're nuts, okay? Because the consumer simply can't handle it. I don't have a real-time number on that. I don't know if somebody does. Maybe go on Poly, and see what we're pricing in as far as, let me see if I can do real-time. On CME, are they really? Yeah, maybe down to 44% real time. Or they hold, yeah. So what looks like real time is we were 45 hold, 55 hike. We're 56 hold, 44 hike. A week ago, we were 33 hold, 67 hike. Okay? So another question we need to ask ourselves is, where is this rally? If we were 67 hike a week ago, and so we're down, whatever that is, about a third, 67 to 44, why the hell are 10s not under, 460, for example? So, yeah, long story short, guys, here's how we trade this. I don't know that we've got a point rally in us today. I don't know that this single number gets us there, okay? I think it provides us a backstop. Like, how much could the Fed hike if we're going to potentially print sequential negative headline non-farm, right? Let's keep in mind that we do not have sentiment at 10. That can't, it's almost always, we do have consumer inflation expectations. So I don't know if this, these calendars have been wonky. You almost always have Michigan on the same day you have the Fed, you have BLS, but maybe we don't. I don't know. Monday, no data. So if you want to take on some risk, you have a free look for a day. Tuesday, ADP and home sales. Wednesday, we roll fannies. And then CPI. Thursday, PPI and claims. And then Friday, we talked about retail sales. I guess Michigan is next Friday. So how do you play it? In theory, we have a free look now until Wednesday. In theory, okay? That statement becomes tenuous based on what happens in Iran, okay? Do I think we've got a point rally with CPI looming and folks potentially being concerned, and rightfully so, about the impact of the oil price blip in that number? Yes. But how much, if that CPI prints, and here's the question to me that we've got to ask ourselves. If that CPI prints flat or hot, even hot, on a day that oil is $58 a barrel, and I'm just making up a number. I'm not saying we're going to be there, right? Does it matter? Does it matter what happened in July? And if we have truce, non-farm, hot CPI, what does it matter? And I think we covered that ground about 2 weeks ago. What's the Fed going to do if we have worsening economic data, and in this case, borderline disastrous economic data? You know, it's not like 200,000 negative, but nonetheless, in the face of some tight prices, tough call. So long story short, if you've got a loan closing next week, you've got a great story to tell. I mean, you've taken on a floater. You've got to be at least an eighth, maybe a quarter in rate better, or fees, a half in fees. You're crazy not to take this chance to lock, this moment to lock, because you just don't have time. We don't know what's going to happen this weekend. At a minimum, you keep an eye on the market today. You see if about any potential negative reprices, right? And you take this day by day, being that there's no data on Monday. All you're potentially fighting is some profit taking or some risk on or something in Iran. It's not onshore data. By Wednesday, you know, you begin to make more of a case to lock, certainly August closings. In terms of your book of business and the mortgage landscape, this number to me signals that August-September rate call that I made days, weeks, maybe a month or two ago, that I said I expect a bond-friendly August-September-ish, October-ish, and I didn't see anything that would put us off that. I still don't. So there you go. But remember, bulls and bears make money, pigs get slaughtered. Thanks for joining live. Thanks for watching on replay. Have a great weekend. I will see you Monday.